Thank you, everybody, for joining us today. My name is Erich Patten. I'm the Chief Investment Officer here at Cutler, and I'm joined today by Bryan Knuston in our Seattle office. And Bryan is a certified financial planner as well as a senior wealth management advisor here at Cutler. And we're going to jump right into it and provide an overview of the first quarter as well as how Cutler is seeing the rest of the year unfolding. We're hoping to take about 35 to 40 minutes of your time today. One thing that I think is important is we're ending the presentation on a bit of optimism. There's a lot of talk about the risk of a recession. We actually have a piece coming out next week talking about market timing and how economic activity and stocks don't always behave the same. But if you have any questions about our presentation today or would like any follow-up, please do not hesitate. But with that, let's jump right into it. For me, the most important disclosure on this page, they're all important, of course, is the start of the second paragraph. The views in this presentation are provided for informational purposes only and represent Cutler's views as of 4/26, which is today. New information becomes available all the time as investors, and we adjust our outlook and our views according to that new information that does become available. And then secondly, always reach out and talk to your advisor or to one of us at Cutler on how the information we're providing herein might apply to your portfolio or apply to your individual situation. All right, so today's agenda, we're going to start off with a first quarter review, and then we're going to ask three pressing questions today that we think are important in terms of how does the economic activity for the rest of the year lay out. The first question is, will containing inflation cause a recession? Secondly, where does the consumer stand now? And then finally, can the market rally broaden from a select few stocks to include the rest of the market? So let's jump into it here. Bryan, why don't you talk about what happened in the first quarter and how that impacts Cutler's allocations?
Okay. Good afternoon, everyone. Excuse me. Get that out of the way now. So after a terrible 2022, and what really made that year terrible was that there was no refuge. Stocks and bonds, as we painfully remember, were both down a significant amount in 2022. That's not typical. Usually in a down year for one results in an up year for the other for a variety of reasons. The first quarter of 2023 saw some recovery back in every major asset class. We're going to go over some specifics in a minute, but on the recap level, bonds to start off with saw some big swings by bond standards in the mix between longer bonds and shorter bonds for some positioning depending on sort of outlook. But the punchline is, now that we have yields again, and now that the bonds have reset their prices from very high levels back to reality, we have a level set for going forward, and that proved out in the first quarter. We like our positioning in the short middle part of the curve. As of today, there really is not a lot of yield upside. There's actually no yield upside for going longer. Some could speculate on price. We don't tend to want to go that way. We don't see the upside, but we like where we are right now. 4, 4.5, even 5% yields are standard at this point. Stocks, the second bullet there, excuse me, the first stock bullet is domestic stocks. Domestic stocks in 2023 have seen a reversal again of 2022, but in this case, it's because growth has outpaced value so far. But when we talk about growth, and we're going to get into specifics later, it's not all growth, it is the mega cap. You're going to hear that term several times, mega cap leaders. We're looking for some defensiveness almost with stocks that are actually pretty overvalued. We like our positioning in a mix of growth and value. We think that value can be very defensive if we do start to see some more erosion in economic activity. So we like our positioning there to have a slight value bias, but still be well represented. Foreign stocks actually had the best quarter of any major class. And that continues the trend that started last year when developed markets in particular, so that'd be Europe, Japan, places like that, outpaced us at sort of the macro level. We think that can continue. Their valuations are still very attractive. Their yields are strong. Emerging markets, another subset of foreign stocks, had another strong quarter. They were solid, not as strong as developed, but good. The reopening process continuing in China can be a big help there going forward. And we like the valuations there. The fourth bullet there, alternatives. We use a very specific fund in that class. That fund, as a proxy for alternatives, actually did extremely well. Once again, it outpaced bonds. It had a nice solid gain for the quarter, and it had a much smoother ride to get there. It didn't have as much price volatility as either stocks or bonds. We love that kind of third leg of the stool.
Yeah, and this next chart really shows that what Bryan just said visually. We call this our quilt chart because it looks like a quilt. And you can see year to date, this is through March 31st, large growth stocks were up 14%. Now, one thing that jumps out to me and something that's important to us at Cutler is downside protection and how downside protection can add value to a portfolio. If you look at large cap growth stocks, they were down 29% last year. Well, looking at the start of 2022 till today, large cap growth is still down about 21% on a round trip basis. Large cap value, on the other hand, which is only up 1% this year, is down about 9% on that same round trip. So that downside protection can really add value by not losing as much on the downside. What else jumps out to me on this chart? International stocks. Bryan mentioned international doing well. There's really a couple of reasons for that. There's been a lot of chatter in the first quarter about the dollar and whether or not the global reserve currency will still remain the dollar. Currently, about 83% of global transactions are dollar-based. We don't think that the dollar is going to go away anytime soon, but US GDP is about a third of global GDP. So the dollar really has been punching above its weight in terms of those global transactions for quite some time. Some deterioration in that does make sense. That does give perhaps a tailwind to those international securities, those international investments, that when you translate them back into dollars, if the dollar is weakening, you're translating them, actually, you're getting more bang for your buck there. So that's perhaps a long-term trend that might help that asset class. The other is valuation. We'll talk about that later in the presentation. Bryan, the big story in the first quarter, though, was what happened with banks. Let's hit that right out of the gate and talk about the banking crisis and where are we in that process.
All right, let's jump into it. We saw many headlines about this, and it might seem like this situation was more pervasive than what it's actually turned out to be. I don't want to try to discount it or dismiss it. It's important, but I want to try to emphasize why this is not a widespread contagion. This is a concentration of very poorly run businesses that all had a domino effect at the same time. Left-hand side here, we can see a timeline. What do I mostly notice about this timeline? For those who can see all those numbers, March 8th to March 19th. We're talking about less than 2 weeks. This is about starting 6 weeks ago to about 4 weeks ago. In that window of time, what happened? Silicon Valley Bank, which had a history of being rather aggressive and poorly risk managed, Credit Suisse, and a few other domestic banks all failed to a degree. Credit Suisse got bought out by a competitor, but still, they had a failure. What was the major failure? There were several factors. The first one is that these banks all got massive inflows of new deposits because of some payouts and other programs that were going on to try to stir up economic activity again, resurrect activity. We saw massive amounts of deposits. That will link over to the right side when I get there. But just keep in mind, these banks were not the mega banks, but they were big enough that they were going, in the case of Silicon Valley Bank, their deposits on hand tripled in the course of about 2 years. What did they do with those new deposits? They're somewhat handcuffed, as all banks are, but what they can buy, but they have to be government issued, they have to be government issued securities. But what did they do inside of that? They bought the longest possible securities that they could. Not universally, but far more of them than any competent risk manager would have said they should have. So what did they end up with then? A bunch of 20 to 30-year treasuries with 2% coupons. That probably seemed like a decent idea to someone when a 1 month CD was yielding like 0.2, but now a 1 month treasury is yielding over 4.5. What happened to those long treasuries? They became not valueless, but much less valuable. They had to mark down. There's a process called mark to market. They had to show that their holdings had dropped and dropped and dropped in value. At the same time, depositors that had poured in billions and billions of dollars said, wait, you're paying me 0.05%, 0.1% on my deposits. I can go out and get a money market fund for 4.5. And we've talked about that here for quite a while. Many clients went and did that. So now what do I have? I'm holding a lot of long treasuries. The deposits I have to secure those treasuries have, to some degree, removed themselves. I have a basket of higher risk loans, some of which were starting to not do very well. That, witch's brew turned out that they were essentially insolvent. This one bank, okay, I don't want to, again, try to stress, this was not universal. This was Silicon Valley Bank. And if you look at their history, their stock reflected the poor outlook for that company. What happened though? Silicon Valley Bank had to close. Okay, then fast forward, Credit Suisse, another stock. I've watched this one, for a while now in morbid fascination. That stock was down 80% from its highs before any of this even happened. What happened? Similar idea, not exactly the same phenomenon over there in Switzerland, but again, people wanted to pull out deposits that weren't paying very much and go get more yield. It's why wouldn't you? Well, the problem for Credit Suisse, same idea is over here. They were already over leveraged. They had some other bad situations that they had brought on themselves with some bad loans and investments. They didn't close, but they had sort of a shotgun wedding to one of their competitors. Okay, so these situations, what was the common denominator here? Very poor risk management, very kind of fast and loose with the rules, and they made some very bad decisions with some of the new capital, the new deposits, I should say, that came in. Okay, on the right-hand side, this is similar, but not the same. This is kind of the macro world of banks. What have we seen since 1990? Way back when, all of 30 years ago, you used to get 50 to 200 new bank charters a year. We had, for those that can see that number in the top left corner in red, 12,000 plus unique bank charters. Where we are now, about 4,200. We have 1/3 as many banks due to some closures, many mergers, many buyouts, and also just a lack of new activity. It is, not coincidental that after the issuance of some new programs and much more new regulation and compliance, there's just not the upside to create new banks anymore. So we can see that recently there's not a new issue of banks. We're getting consolidation of banks. That leads to this sort of, not even just the mega banks, but a lot of mid-size, like a Silicon Valley Bank. They got much more in deposits than they would have otherwise. That all together sort of led to this phenomenon. But to fast forward to the next question, do we think that this will continue? There are a few more banks out there that are sort of on lifelines, a very small number, but there are a few more out there. After that, though, other banks are looking very solid. This is not a universal trend. This is an isolated trend.
Yeah, thank you, Bryan. And the question that it leads me to ask is this banking crisis doing the Fed's work for them? Meaning, is this going to help reduce inflation in our economy? And that's our next question. Will containing inflation drive a recession? Are we headed to a recession? The bank shock really changed the dynamics for interest rates out there. And you can see on the left-hand side, in orange was the previous Fed rate hike expectations. After Silicon Valley Bank failed just a week later, you can see a dramatic shift downward in that future interest rate curve. On the right-hand side, this is the current trajectory for interest rates. You can see the immediate number at 4.82. We have a Fed meeting next week, likely to get another 0.25 basis or 25 basis point increase. And that's where the market thinks will be the peak interest rates is on May 2nd when the Fed meets. From there, interest rates move down pretty aggressively. And it looks like market expectations are pricing in a recession. But one thing to keep in mind is that the market has been pricing in a recession for a year and a half. And you look at these next slides, the 10-year has been inverted for over a year. And when the yield curve inverts, that's often an indicator that a recession is coming. And it's really as inverted today as it has been at any time since 1980. On the right-hand side, you can see leading economic indicators are also very low. That's another indicator that a recession might be coming. And in fact, even in the Fed's most recent minutes from their recent meeting, they acknowledge that a third quarter recession is in their base case scenario. So the Fed is raising rates, even though they think that we could have a recession, largely because most economists out there don't think it will be a deep recession, but think it will be a shallow, more normal recession. Well, what happens in recessions? Well, the Fed cuts rates. And you can see on this chart, this really shows how dramatically the Fed changes rates during a recession. Now, could this time be different? Yes, it could be. One major factor here is inflation. And Bryan, we're going to move into inflation now to talk about the stickiness of inflation, because the ability for the Fed to lower rates in a period of economic weakness is going to depend on how much inflation is moving downward.
Okay, so on this chart, this is yet another indicator where you could probably say this on almost every chart. Things are getting better, but they still have work to do. And why do I say that? There are two measures of inflation on here. We have two that are sort of generally utilized for the consumer side. The red line is the headline CPI. That's the one that you will usually see headlines, as the name would indicate, about. That's the one that does include food and energy, which is specifically food and gas, mostly for those of us that have to buy those things, which most of us do every week, if not more often. So the red line, if you go back to 2000, first note on this does not include the 1980s and the 1970s for this particular chart. So we don't see that comparison on here. We're really looking at the last generation. In that time, the red line does show more whip, more kind of frothiness than the blue line. But previous to this most recent several years, a high mark, if you see in about 2008, for the red line was about 5.8-ish. The low mark was about a -2. Okay, that was an extreme financial situation, as we all recall. But what I even note there is the blue line, the core, which excludes food and energy, did not move nearly that much. This entire time, relative to 2020, it was moving between about 1 and 3. It was very kind of regimented. Okay, what happened starting in 2020 to 21? The blue and the red line both accelerated way too fast. We all know this. That's what we've been talking about for the last 6 webinars. But what do we see in about the last 9 months? Both of those lines are trending down. That is very positive news. However, there's always going to be a but or a however here, right? But the blue line is still well elevated over what first the target is, and second, what its own history is. Okay, so it is improving. It absolutely is improving. The forecast going forward from the Cleveland Fed, which sort of is the tracker for Fed projections on inflation, they expect that next month we would see the headline go below the core. That could be caveated by the resurgence in gas prices, but the trend would say that even that red line might go down below the blue line. The blue line tends to be very sticky because it is very services heavy, right? You don't tend to get a coupon or a discount or a sale on the price of services, whether it's a doctor visit or whatever it might be, textbooks, right? You might get some discount. We're going to talk in the next slide about specifics on certain items, but at a macro level, services don't tend to come down in price. And if they do, it doesn't tend to be for very long. We need to keep chipping away at some of the specific inputs there and bring that number down. That 5.5 is better than 6.5, but it still has a lot of work to do.
All right, Bryan, so let's talk about the stickiness of inflation. And we've seen a resurgence of services. And if inflation stays higher for longer, that would also suggest that the Fed might stay higher for longer. In that scenario, investors would want shorter term bonds versus longer term bonds. They might also want value stocks versus growth stocks. How is services impacting the rate of change for investors?
So what I love about this chart is it's a very clean, easy way to break out price history by type. And this goes back to 2000. And let's start down at the bottom. The price of, well, first the prevalence, and then second, the price of items like cell phones and flat panel TVs. Think about 20 to 25 years ago, not everyone had a cell phone. I didn't get my first one until probably 2003, maybe. it was kind of like, maybe I'll get around to it. Now, of course, almost universally, we all have one. The price of those has come down. Of course, that's dependent on models. There's always more expensive ones, but at a macro level, those prices have declined. Look down at the very bottom, televisions. My first flat panel TV was not very good, and it was $500. I just got one from my kitchen that's probably 5 times better. That was $80, right? Those prices have come down thanks to innovations in processors, et cetera. The technology side of things has driven down price. We can still choose to pay more, but we don't have to pay more. That has helped both the blue and the red on the previous slide, right? One of the reasons why we haven't seen as much push up in certain areas is new innovations have helped those areas stay low. That's great for us. Okay, so that helps us to afford the next level and the next level. The next level up from there is clothing, sure, but let's look at cars. Cars is, once again, I can get a $10,000 used car, I hope, or I can get a $500,000 supercar, but I, in general, can go and get the same type of car I've had before at kind of the broad class level, and it won't cost that much more than it did before. It might feel like it because of the depreciation of the one I already had, but the sticker prices haven't really changed that much. Once again, thanks to some innovations and things, and also the length of time people are keeping their cars, right? So that bottom half, let's call it, is very containable and manageable because of innovations and the ability for something to last longer and just lower prices to make them. Then we change up. The next level up is food and housing. Those have progressed up. They are more expensive, especially recently. Recency bias might make it seem like those have always been going up at these massively elevated rates. They really haven't, right? They have, well, housing in particular is going to depend on interest rates. When those were, when I got a 2.25% mortgage, sure, yeah, I was going to jump on that, but that's not always going to be the case. Food and beverage has had, if you can see the specific lines, that's had a really large recent jump. We all know that as well, but that is a unique phenomenon. That has not happened before. That area, those pockets are especially important because of how much of our money goes there, and that we pay it on a recurring basis, so we notice it all the time, but they haven't really been that bad on an annualized basis. Then we get to the tough news. The first 5, really, if you go from top to bottom, these have all seen very large increases in price. And what is the unique circumstance here? They're all service related, right? Medical care, education, childcare. Every one of those hits certain people for certain pockets of time, and they all can involve very large payouts at once, which, being the type of creatures that we are, we remember that very much, right? We remember things that feel painful. What can feel more painful than writing a $50,000 check to the hospital or a $50,000 check to a college, or both, right? Those, first, they have increased the most, which makes it painful. And second, they come in very large installments that can really make them memorable for us, and not in the best way.
Yeah, Bryan, I look at this chart and I see a great reason to own stocks. If you look over the last decade or so, inflation was actually very tame. One of the most consistent periods of low inflation that we've ever had. And yet still you see on this chart, the things that we save for, the things that investors are building for. Most of our clients are not investing to buy a new TV. Most of them are are investing to buy a new house or to save for those medical care expenses that they might have one day. And really, stocks are a phenomenal long-term vehicle for keeping up with this rate of inflation. So even if the Fed is successful in bringing down the headline numbers, there's still going to be some underlying inflation that investors have to deal with. Inflation does correlate very well to what consumers are doing. Obviously, when you go to a restaurant now and that $10 burger is now a $15 burger, you notice the food price inflation very much. How has that impacted consumers, Bryan? We've talked in the past how consumers are 60% of US GDP. The health of the consumer is very much going to be an important determinant on how deep or whether we avoid a recession altogether.
Yes. So the punchline that I'll start with and then get into specifics is consumers at a macro level, we are still healthy, but we are starting to show maybe we're coughing a little more, or whatever sort of metaphor I want to use. How do I know that we are macro healthy? Look at the very left-hand side. We look at this quite often. I love looking at this balance sheet because this is what I do for clients. How are we doing relative assets to liabilities? Overall, we're still doing very well. So I'll start with the good news and then get to the part that we hope it will not continue on the trend that it is. How do I know that we're doing well? Well, first, we have an 8-to-1 assets to liabilities ratio. That's great. That's absolutely great. And not only that, it's not hyper concentrated in one area. 29% of our assets are in the equity of our home. Actually, well, this includes mortgages, so that's like the assumed value of our homes. Okay, that's a large number. Some areas are overvalued for sure, but that's always the case. Some are undervalued. That's also always the case. Drag down to the bottom, other financial assets. That is the biggest piece of the pie, but that includes the most aspects. That's retirement accounts, that's brokerage accounts. That is going to be any of those invested type assets that are not pensions and they're not deposits in the bank. Those have their own category. 39%. So what can I see? My financial assets and homes, those two together are going to be the biggest components, but neither of those dominates to the level where it's a majority, right? We are very well diversified. Drag over to the right there, or just to the right of that. Mortgages are our, can I say that right? Number one liability, but that's fine. We're going to talk about some stats on that. The good news is mortgages are a very containable number. The numbers above that are so small in the macro level, they don't even really show unless you look up. They get a lot of attention for sure, right? Student debt gets a lot of attention. It is a big number. It is not a big number in the macro field. It's a very big number for certain people. Completely understandable. The other areas there do have some areas of concern, loans, et cetera, for very specific people. Let's talk about what is driving that. Let's look in the middle there. The household debt service ratio. How much of our income is going towards debt maintenance? It's not really a bad number. It's going up. We hope that trend line doesn't continue to go at the level that it has recently, but compared to history, it's not bad. It's still under 10%. As of today, it's probably right at 10%. That is lower than we were in 2007. That is right about the trend line for the last decade or so. That's not bad. It's not where we are. The next question is going to be, where are we going? Look down in the middle part. This is where we're starting to see some signs that maybe the trend isn't good. We just hope that that trend will start to level off. Early delinquencies on auto and credit card loans. These are always going to be some of those leading indicators of whether there's strain and stress on households. The number was very low for a while there because we weren't really using credit cards that much to go make big purchases when there weren't a lot of purchases to make and people had cash on hand. We'll get to that next. But as that cash has been utilized and as the credit cards are being used more and sometimes too much more, we're starting to see that number trend up. But once again, let's look at history, right? Back in 08, we are nowhere near the stresses that we were in 08. I just want to emphasize that again. Look at both of those numbers and especially look at credit cards. 14% delinquencies. 1 out of every 7 credit card holders was delinquent on payments and we're paying massive amounts of interest. We are half of that right now. That's good. Now let's drag over to the right. This is a number that has continued to get a little bit worrisome, but it's not bad yet. It's just getting worse, if that makes sense. Let's try to break this one out. There's a lot going on in that little chart there, but basically what we're looking at is the trend line that's going from left to right that has the red circle in the middle. That is the expectation of how much we would have in household savings in a given year. You can see that the expectation is that it's always going to go up by a modest amount. It did go up in 2020 and 21 by a massive amount. That's that blue kind of spike line there. It went up, came back down, went up again with some more payments in, came back down. It has crossed under where expectation was that it would be and has continued to trend down. That is a strain. It's not a strain to everybody. It's a strain probably mostly to the people that are impacted by that middle bottom chart, right? These two tend to go together. People that are not accustomed to holding a lot of cash, have some cash, they use that cash, and then they are kind of overstressed again. That's what we need to watch out for.
Yeah, so there's a little bit of weakness in the consumer, but not too much. This slide really just re-emphasizes something Bryan showed on the previous slide, which is the total debt service for Americans. Mortgages being the biggest component of debt. The left side shows that over 90% of mortgages are under 5% with a 30-year fixed. So people are very well positioned for rising interest rates when it comes to mortgage lending. And the question that you're left to ask is, well, are Americans, stuck in that loan? Are they able to move to a new home or relocate? This will be an interesting trend to unfold. We don't have a definitive answer today, but the chart on the right shows how many homeowners are searching for properties outside of their current residence or current metro. And you can see that's at a record high. So thus far, it hasn't prevented Americans from relocating, or at least looking online for a new home. But we'll have to wait and see what happens with interest rates in terms of that impact on the housing market going forward. And finally, one last slide on the consumer. Bryan, household net worth is down. How does that make consumers feel? Where's sentiment? Sentiment is really a driver of how people feel about the economy and can be a self-fulfilling prophecy to a certain extent.
It can be indeed. We are a consumer-driven society. Eric noted the number before. It's right about 2/3 of activity is dependent on you and me and everyone else feeling good about doing what we need to do. I never feel good about writing my utility check, but I know I need to. But I need to feel good about making other purchases as well. Left-hand side here, what we see is a drop in total household net worth, home and assets and bank deposits. A drop is rare, right? If you go back in history, there's only 3 on this chart. The one in 2022 was mostly unique because, just as we noted on way back at the very beginning, stocks and bonds going down together was a unique circumstance. They were both overvalued. They were both somewhat overvalued based on zero interest rates, but we did get a drop. But the first thing I would note is, even with the much higher household net worth that we have now, as we saw on the stack chart a couple slides ago, versus the past, the drop was half as much as 2008. Sure, 2008 was much worse, and it absolutely was. 2008, we also got positive returns from bonds, so keep that in mind. And household net worth, if you see all the numbers between 8 and 22 on there, we have been, I didn't do this math, but I could do a quick guesstimate and say we've probably gone up $70 trillion between now and then. And that's massive, right? But even with that in place, the drop was noticeable. Drops are never fun. I know that very well myself, but it was half as much with much more assets at stake that could have gone down. So the good news from that is it was a drop. We don't like that at all, but it was much more containable. Drag over to the right. Sentiment is an interesting one to try to measure because it's not really on a 0 to 100 scale. It's somewhat like VIX, when you've heard me rant about that before. This is difficult, but if you just look at the trend lines, what we can see is back in 17, 18, 19, 20, the trend was to be somewhere between about 90 and 110. So let's say 100, just to split the difference, is about average. Work with me on that. Let's say that that's about average. It started to go down. It started to go down in 20 and 21 for many reasons we all remember, and let's not get into that. But then in 22, it bottomed out. It got to about 50. And those of us who remember about 3 presentations ago, Eric and I talked about that number on a different chart and said 50 is ridiculous. This is way too low. We have sort of jumped the shark, to use that old reference. This can't sustain itself, and it hasn't. Right? It went up. It got back up into the 60s and the 70s. Still lower than we want, but still much higher than 50. It did come down in March. That's that red highlighted area. That was not our highlight. That's from the source provider. Just to note that, yes, there has been a reaction to bank unrest and to gas prices coming up again. Again, the punchline of that one is to say, this is not static recently, right? We're not trying to just find, oh, it's only going up. No, it is still reactive to news, but even the reaction of those pieces of news, it is still well above where it was last year. That bottom out in 2022, we hope coincides with a bottom out of stocks and a bottom out of some other things. The good news overall, though, is we're off the lows and there's still a lot of room for improvement there.
All right, so let's move on from the consumer and really talk stocks and markets and how what's happening out there in the economy is influencing the markets. But the question that we're asking, can the market rally broaden from a select few stocks we've seen an incredible concentration of returns in the S&P 500. And you look at the left side of this chart, it shows the returns of 8 stocks in pink there, and then in blue shows the returns of the remaining 492 or so stocks in the S&P 500. And you can see the 492 were negative in the first quarter, and the pink stocks had an outsized return that is highly unusual. So what are those 8 stocks? It's Facebook. On this chart, it's labeled as FANG plus MNT, or FANG plus Mint. Facebook, Amazon, Apple, Netflix, Google, Microsoft, NVIDIA, and Tesla. And there's different reasons why those 8 companies have contributed so much to the S&P. In the case of Apple and Microsoft, it's really because they are just so big, about $2.5 trillion. Obviously, if they move, the market is going to move significantly with it. But this trend got really outsized after the banking crisis. And in many ways, those companies in particular were looked at as a quality trade. So people were looking at the stability of Apple and Microsoft and moving money out of perhaps some riskier investments into those companies. There's other names on this list that might be trading higher for their own reasons. You think of Facebook and their cost cutting from the metaverse. They're up after hours today based on cost cutting and earnings announcements. You think of Tesla, which was down quite a bit last year, just kind of having a bounce off of those lows. NVIDIA is a chip company that's benefiting from a tailwind for artificial intelligence. So there's different reasons why these companies are doing well, but at least in the case of Microsoft and Apple, we haven't had the concentration at the top end of the S&P since IBM and Exxon. It has been a very long time since we have had, I believe it's about 11% of the S&P is those 2 stocks alone. On the right-hand side, you see the NASDAQ Advanced Decliners line. And really what this is telling us is the same information in a different way. We're seeing very few advancers, very many decliners. Those advancers are the big companies that are holding up the ship for the whole market. But we really need to see some growth from the rest of the market in order to have a broad-based rally. This cannot be an 8-stock rally. Well, I never say cannot in our business, but we really think that the breadth of the market needs to help the market to move forward into a bear market or bull market. And what could do that? Well, it's going to be earnings. Bryan, you can talk about earnings here on the next slide. But just one quick anecdote. Thus far in the first quarter, there's been some good news on an earnings stand from positive earnings surprises from value have outpaced positive earnings surprises from growth. So we are actually seeing some of those left behind companies surprise to the upside thus far from the first quarter. Bryan, how are valuations for the broader market? Where do we stand from here? I know we've looked at this chart before, but why don't you point out what you think is important on this?
Okay, so this is an overview of the S&P 500 exclusively against its own history. And the line chart down at the bottom shows, that there's been lots of peaks and valleys in the past. This goes back to 1996. We see some kind of pyramid type shapes, and then that really long sustained rally, which did have many hiccups in between, that lasted from 2009 until about 2020. I can tell you there were years in between there that were not that great, but the trend line was positive. We got the sharp drop in 2020, rally back up, and then a noticeable drop last year. Okay, that's the history, and it makes it look very smooth. That's a nice part with multi-year views. But let's look at intervals of time. That's going to be that chart in the middle there. The main thing that I would note right now is that, sort of like Goldilocks, we're not too expensive and we're not too cheap. We are right at, and we're going to get into the specifics, but we are right at about the 25-year average. What makes it different is to touch on what Erich just noted before, and this will continue to be the case given the earnings, a few more that we just found out about. The valuation of the biggest companies, by and large, is getting very stretched. The valuation of some of the other members, when there are very many of them, not so stretched at all. But when you look at it at the macro level, when something is market cap weighted, when something that is twice as big as the company next to it has twice the impact of the thing next to it, that's going to be very important to note. 18 times earnings, which is depending on who you look at for projections for this year, we could be trading as low as about what it shows there or as high as 21. But based on what we know right now, 18 times earnings, that is not bad. It's lower than at the end of 2021, beginning of 2022, far lower than back in 2000. I mean, that was night and day difference. Look at that, 25. Boy, that was rough. It's higher than it was in 2007. However, a little caveat there, 2007, remember, everyone was borrowing money and we were leveraged up to the hill. That is also no longer the case. So relative to those past points in history, this isn't that bad. Another thing to look on there is the dividend yield over all these different time periods, that third line down, the amount of yield you get from stocks specifically, that hasn't changed very much, right? 1.3 to 1.9 is the range there. That's rounding error of difference, really. What is different in these environments is the last line, the 10-year treasury. Keep in mind that at this time last year, we had one rate increase of 0.25%. The Fed was still saying for the entire year last year, we might get 2, we might get 3. Jamie Dimon from JP Morgan came out and said 7, and people thought that he was a lunatic. How many have we had so far? 19. Next week or 2 weeks from now, we'll probably get 220. Okay, so what did that do? That impacted 10-year treasuries and other things. But a 10-year treasury became attractive again. So that's what the other thing we need to be aware of now is there is an alternative. For those that remember us, the TINA, there is no alternative. For several years, that was a reasonable statement. Now there are alternatives, which is one reason why bonds were up in the first quarter. So if I look at this in general, what am I looking at? Earnings. We have to maintain those earnings. And it can't, again, to echo Erich's point from just now, it can't only be the megas, right? Those doing well is helpful, absolutely. But we need to continue to spread out and branch out and look for more breadth, right? 8 companies cannot carry the other 492 for very long. They can't do it for a while. They can't do it for very long. We need more breadth. And I think what this shows is that we're not grossly overvalued. At the end of 2021, yes, we all talked about it, even this webinar. Yes, we're overpriced. That was reasonable based on very few rate increases. We've had not very few rate increases. We had to reset expectations. That is happening now for going forward. What we need is earnings. We need earnings to maintain stability going forward.
All right, well, we have 3 more slides to show you here. And the first, we're going to talk about developed foreign countries continue to look attractive. We've already mentioned that, but on the left-hand side, you can see a stock performance chart from Europe versus the S&P 500 and see how for the last year and a quarter, really European stocks have had some nice performance. The dollar we've mentioned is part of that story. Valuations are also part of that story. On the right-hand side, we have really in the light blue diamond there, the current value versus the purple line, which is the 25-year trend. And you can see both Japan and Europe, which in our client portfolios, we consider the same investment. So it's a one fund that would have exposure to both Japan and to Europe simultaneously. But both of those are trading well below that purple line. And you can actually see on this chart, the only market or asset that is overvalued is the US at 17.8 times earnings, but still well within reason. And I do want to emphasize US stocks are not overvalued if earnings hold up, and thus far they have been. So US equities, despite the rally that we've seen in the first quarter, are still well positioned, but this outperformance might be explained by some of the valuation opportunities on this page. This next chart is really the same kind of chart as the last one with those diamonds, and it shows some opportunities out there. Brian, where do you see these opportunities across the board in client portfolios right now?
Sure, yeah. So just look at this quick. I know there's a lot of data on here, but basically the green diamonds say that everything at the end of 2021, beginning of 22, were either at or over what would be reasonable value for them. We all went through the washout of 2022, or not washout, sorry, but the drops, 2022. Where are we at now? Left to right, we see what is most below its own average over the last 25 years versus what is still above. And to reemphasize what we've already said several times, developed markets, emerging markets, some classes of bonds, including treasuries, which I would have never said 18 months ago, and small cap have some capacity for upside relative to their own histories. Over on the right-hand side, just to emphasize again what we've said, US growth, is it overpriced relative to its own history? Yes, not grossly so. Some certain specific companies are, but not all of them. Everybody has come down from their own history, or from where they were about 5 quarters ago. There is still good upside potential there. And this shows us that it's not just in one or two classes. There is some breadth here.
So yeah, that gives you really some optimism, some reasons for investing. We also want to end on this slide, which I think is a great optimistic slide. When you think about the long-term value of investing and really why we all participate in the stock market, and really it's that human I guess capacity for growth or for development. And the world has continued to improve. Extreme poverty over the last 200 years has gone from 6 people out of 100 not living in extreme poverty to 10 now living in extreme poverty. So it's completely flipped that dynamic on its head. Basic education has been consistently on the rise, literacy, democracy, all of these metrics create opportunities for growth, and not just for foreign countries where maybe a lot of that extreme poverty is taking place, but for US companies as well, that are global companies that have reach around the globe. We think that this chart, or these charts here, really do express optimism, and investors who have been patient and willing to kind of wait through times of volatility or times of turmoil have been grossly rewarded for that patience. So we don't think the future looks any different today for investors. We do think that there's reasons for optimism and reasons to remain invested. So with that, I just want to say thank you to all of you for joining us today. Again, if you have any questions, please reach out to Bryan, myself, or your advisor at Cutler to discuss them. A copy of this presentation will be available on our website shortly. We invite you to share that with friends or colleagues that may be interested in Cutler's thoughts. And I just want to say thank you for your time today, and we look forward to doing this again next quarter.
Thank you all very much.